Hey there, this is Joe Simons, like diamonds, with Retirement Think Tank. We've got some really big news here today. This just came out today on Tuesday, July the 1st, right before 4th of July and right before the big World Cup game today against with USA. But the news is about 401ks, and you're now going to have the ability to get annuities, in particular a longevity annuity or a deferred income annuity inside of your 401k. Now, here's why this is a big deal. For those of you that don't know about these longevity annuities, it really is like the fastest growing insurance out there, and it's insurance against longevity, meaning you running out of money and living too long. And primarily this has been done independently with carriers and their own distribution arms, etc. And you can't really get these inside of your 401k. The main reason is because of RMDs, what's called as these required minimum distributions that our lovely government forces us to take money out of our qualified plans like traditional IRAs and 401ks so that they can start getting some of that tax money back. And you have to do that at age 70 and a half, no matter what your situation is, unless you have a couple goofy ones, you can get some of the money out earlier, but you're always forced, unless you have a Roth, to take that money out. That's been a big problem is regarding annuities inside of 401ks. But a new ruling that just came out today, and I've got it here in my hands, from the Treasury Department, they just announced that workers, employees of employers that have 401ks can actually satisfy this RMD rule if they used to use a portion of the retirement savings inside of the 401k to buy that annuity. And you can hold this all the way up to age 85. And this move is, part of the Obama administration's, I guess, kind of broader effort to find ways to make sure people aren't running out of money, because it is a big fear that most people today don't have pensions like our parents and grandparents and great-grandparents did. And so many people are relying on their 401ks, and if you look at the average size of a 401k, it's not anywhere close to making sure that people are not going to run out of money. It's actually quite scary. These new rules take effect immediately, and here's really what the rules state. I'm going to read this. To avoid these distribution rules of the old RMDs, retirement plan participants can use no more than 25% of their account balance or $125,000 to buy the annuity, whichever is less. So, for instance, if someone had a $500,000 total 401k balance, they could buy the full $125,000 deferred income annuity or longevity annuity. Now, what they would be doing is they would be taking that full $125,000, assuming they had a $500,000 401k or larger. They could take the full $125,000, not forced to, but this is an option, of course, and they could go lower if they wanted to. But they take that amount of money, and they would basically purchase this longevity annuity. Now, they could hold on to it for 1 year, 5 years, 10 years, 30 years, just depending on their situation, how old they were, and what their goals were. But that's what's neat about these longevity annuities. The old deferred, the income annuities, the non-deferred income annuities, are what's called a SPIA, or a single premium immediate annuity. And in those instances, you would put money in, $100,000, $125,000, whatever it might be, then income would start immediately. And it could start for 5 years, 10 years, or it could go for 5 years, 10 years, 20 years, 30 years, lifetime, really whatever you specify. And that's what I think a lot of people, when they hear the word annuity, think of those old school kind of SPIAs. Now, these newer and very popular longevity or deferred annuities, you're going to defer that money instead of starting it right away. And you're basically letting the insurance company manage your risk. That's really what you're doing, and hoping that the insurance company is going to be able to do it better than you could, which in many times they are. And they're going to take your money, and as long as you're deferring it and letting them hold on to it, they're going to give you some kind of underlying interest rate. And then when you do elect to turn it on, they would give you a whole lot more than had you turn it on right away like an immediate annuity. They also say here, anyone who inadvertently, mistakenly, exceeds the limits of this 25% or $125,000 will have the opportunity to correct the error without penalty, which is nice of them to do that. The annuities must also be relatively basic. They can't be laden with a lot of these different riders and things that are popular today, so keep that in mind. A couple ones of riders that they will allow is features that guarantee the owner's beneficiaries will receive the premium amount originally paid minus any payments already made. That's a really good one. And for those of you that hate annuities, that's probably one reason why you think, well, hey, if I put $125,000 in, I finally turn on my income and I'm getting my $5,000 or $1,000 a month, whatever it is, and all of a sudden I die in year 2 of taking income, the rest of that just goes to the insurance carrier. In this case, with these riders, that's not the case. Anything left over, your beneficiaries will get every penny of it, which is a really cool feature. They also are allowing the rider that says that the income stream could continue to pay to a spouse or any other beneficiary, for that matter, upon the owner of the annuity's death, which is also a nice one. That'll both be 2 riders. Keep in mind that anytime you have a rider like that on there, it is going to reduce the overall income. It just makes sense. It's the insurance company is got to charge for that somehow, and they are going to take that out of your future payments. And it might not be much, but all that stuff does add up. It remains to be seen if these new rules really will prompt a lot of these 401k admins and administrators and HRs to really embrace this, because they have had the ability, most 401k plans have had the ability to put annuities in there, and some of them have. It says about 1 in 5 401k plans today offer any kind of annuities, yet even the ones that do, it's very few people, a very small percentage of the people are actually electing to put their money in there, which I thought was interesting. So this will be very intriguing to see if a lot of these 401k administrators embrace this and start doing it. A big question that I have, and I think we have it here at Retirement Think Tank, is what happens to that commission? Normally, if someone sells, like an insurance agent or a financial advisor, sells one of these plans, these longevity deferred income annuities to you, they make some kind of commission from the insurance carrier. It doesn't come out of your pocket, it's coming out of the insurance carrier's pocket. So the big question is, what happens when big 401k plan with potentially hundreds or thousands of people sign up for this? Are they going to cut the agent and the distribution model out completely and just go to the HR department or the admin of the 401k and cut them a deal, if you will, and waive all fees, meaning this even lower your fees inside of your 401k? If you think about it, since this 25% potentially is not going to be really part of your 401k anymore, it's almost going to be kind of held outside in a separate annuity fund, you shouldn't be charged on that like you would on the normal funds instead of a 401k. So this could have a second bonus. Besides creating some kind of contractual lifetime income stream, it could actually lower the fees on up to 25% of your 401k balance. So that'll be interesting to see what happens with commissions, and if they're able to take some of those commissions that they would have paid to an agent and put them back into the annuity and make them even better. That would be obviously quite interesting. So this is all about protecting risk. This is really what insurance is. Just like you would buy car insurance or homeowners insurance, etc. You kind of hope you don't have to use it, but it is there, and that's one reason that you should never put all of your money in this. But gosh, what a really neat way to hedge your bets that you do live a long time. And I think this is just fuel to the fire of 401ks. I mean, I like 401ks. We love all these retirement plans that are kind of helping you and forcing you to save money. This is pretty powerful stuff to have now, the first ever contractual lifetime income stream where you're not forced to take the money out on this portion at age 70 and a half. So that's all. Stay tuned for more, and definitely check out retirementthinktank.com.